Good afternoon. I think I was supposed to say good morning, but it's after 12, so good afternoon. It's great to see all of you here. And a fantastic turnout. So well done to Christoph and the team for bringing so many people out here to hopefully get advice from a great panel like we just saw now, and the rest of the speakers throughout the week. What I'm going to talk about today is just really about navigating economic headwinds. There was a lot of reference in the previous panel about we're going through very uncertain economic times. Now, I've been, just my background quickly, so I was the CEO of Accenture South Africa. I spent 28 years at Accenture, but during my first 5 to 10 years, probably 10 years of Accenture, I actually worked in Silicon Valley, building tech companies. I've been through quite a few exits, sold quite a few companies, nicely in dollars, so it was actually a very nice little exit to get. And then I spent, well, at the same time, spending the time in Accenture, probably advising and building about 100 tech companies, purely tech companies. I'm not into solo or anything else like that. And yeah, what I did, what's important though, I went through 2000. I was at front row seats to the downturn in 2000. I had front row seats to the economic downturn in 2008, 2016, and what's happening now in 2022. So what I want to share with you today is the experience I've had over many, many years now of seeing economic downturns and what you guys as entrepreneurs should be doing to make sure, for one, that you can sustain your valuation, but more importantly, that you can actually survive and thrive in these tough economic times. So just a quick show of hands. How many of you are founders or entrepreneurs in the audience? Okay, for the ones that didn't put your hand up, what do you do? Why are you here? Okay, I won't answer. Okay, but there's a lot of entrepreneurs here. I think it's important. So for me, my objective of what I want to achieve in the next 20 minutes, I've literally got 20 minutes, is if you could just, not just about more information, I want you to work out a plan of what you can do differently. Okay, can you, that's better. Okay, so what I want you to do is not just about getting more information from me, it's about coming up with a plan of what you can do differently in your business. Now, I'm going to share with you today my experience, what I'm doing with all my investing companies, some actions we've taken. I think we've really taken some businesses that weren't going to succeed, and we've made them hugely successful based on some of these actions. But there's not one playbook here, guys. I want you to understand, this is not one playbook. We are able to see around corners, and it doesn't apply to every business. So that's first and foremost. So let me just quickly go into who we are as Kalon. So we as Kalon Venture Partners, we raised we were a Section 12J company. We raised R250 million in funding. We've got 11 investments, hopefully have our 12th investment shortly. And we're going to go out and hopefully raise a $50 million fund, which will be our Fund 3. So I'm the CEO and founder of Kalon. We've got a small team. But very importantly for us, we are the entrepreneurs behind or for the entrepreneurs. We're not investors first. We are entrepreneurs. We are operators. So we are operators behind the operators. A lot of VC in South Africa, unfortunately, and I'm not knocking anyone here, you get guys from a private equity background or lawyers or attorneys or accountants. We're not that. We're tech entrepreneurs. I've built all those tech companies and helped build many, many other tech companies. So the advice I'm going to give you today is from building tech companies. So we are the operators behind the operators. We actually roll up our sleeves and help you take your business from $0 to $1 million to $10 million, hopefully to $100 million. And we are doing that with many of our businesses today. So really, I said about Kalon being the entrepreneurs behind the entrepreneurs. We partner with these visionary entrepreneurs defining the future of the industries to transform Africa and the world. We don't want to just take our business from South Africa to Africa. We want to take it from South Africa, and globally around the world as well, to get that big exit as per the previous commentary. So what's the agenda quickly? So I want to share with you, what are those 6 survival metrics I'm going to share with you that you should know, whether it's your SaaS business, whether you're an enterprise B2B, but particularly for enterprise business, and share with you those things. What interventions should you be taking and looking at? And as I said, there's no one size fits all, but what interventions should you be looking at to make sure you can sustain your runway and you can get to profitability, that you can make your business an enduring business. What are the key drivers to health? What are the matters most growth versus efficiency? And I'll talk more about that. The very importance of unit economics. Someone asked the question, what do you look for in entrepreneurs? The most important thing I look for in entrepreneurs is they understand their unit economics. Warren Buffett said accounting is the language of business, and accounting is the language of business. And you as an entrepreneur don't have to be the accountant, but you have to understand your unit economics. You cannot ask your accountant to explain to you how you're doing from a unit economics point of view. And what does best in class actually look like? Sorry, that was the wrong slide. So let me just go through the 6 metrics quickly. So this is an indicator of the overall health of your business. If you know these 6 indicators, and if you're going to come to me for capital, I'm going to ask you about these 6 indicators. Number 1 is revenue growth. We all understand revenue growth, top line growth. And just to share with you, there's an adage in venture capital called 33222. So for those of you who don't understand that, when you start off in a business, you should be, if you really want to be in the top quartile, you should be taking your business from $1 million to the first 3 to $3 million, to the second 3 to $9 million, then to $80 million, $36 million, and $72 million, or rands, or whatever currency you're working in. So it's 33222. That's what we look for in terms of revenue growth. It's interesting. How many of you can grow your businesses at 6% month on month? Of those entrepreneurs, how many of you think you can just achieve 6% month on month growth? None of you. Okay, that's the sorry tale. But 6% month on month growth, if you want to be a venture capital backed business and you really want to hit the 333 double, you've got to be operating at a minimum 6%, which gives you 100% annualized growth. If you grow 10% per month, you'll hit the 300% growth on your revenue. Think about that. Just 10% month on month, 300%. 6% month on month, 100%. The second one is net dollar retention. I'm going to talk about all these now in the subsequent slides. The rule of 40, which is a measure of capital efficiency. The burn multiple, also a measure of capital efficiency. The magic number, sales efficiency ratio, and the gross margin. So these 6 metrics is what I'm going to ask you to answer in a pitch if you go there. So let's talk about net dollar retention first. So if you don't know the term net dollar retention, net rand retention, net whatever retention, the top companies in the top quartile are getting 100%, 20% net dollar retention. So what I mean by that, so if you've got 100 current clients and they're doing $1 million, just from those 100 clients, you'll get $1.2 million. So your net dollar retention will be 120%. So just from current clients, you're growing the revenue and the basket size an additional 20%. So there's no additional sales. Your customer support people should be, they are the ones should be leading this, and you have to see customer success and customer support as a revenue generating function. It's quite interesting. In one of our businesses recently, the customer support team had a higher growth percentage forecast than the actual sales team. And because why? Because it's 6 times easier to sell to your current investors as it is to sell to your new investors. The number you should be looking at, if you want to be in the top quartile for enterprise business, is 120%. So you go from 100 to 120 with no new logos, and 10% in SMB. So the growth from existing customers, guys, is where I'm saying you should be focusing. Everyone gets a new customer, and what are the first thing they do? They go and worry about new customers. The worst thing you should be doing, because it is so hard to sell to new logos. I'm not saying new logos are not important. Of course they're important. But just remember, your current logos is your easiest, lowest hanging fruit to actually sell to your current clients. Let's go to the next one. Something called, who's heard of rule of 40? Anyone? Okay, one person in the room. But let me explain to you what rule of 40 is. So it's a growth versus efficiency at the top right-hand corner there. What matters more? So there's no growth or efficiency. But in today's times, things have changed in the last year and a half. Efficient growth opposed to growth at all costs. Because if you go back to 2021, 2020, everyone was driving top-line growth. Top-line growth, top-line growth, top-line growth. They were driving 100, 200, 300, 400% top-line growth. Why did they do that? Because they were rewarded for it. Because the venture capitalists said if you grow your top line, they'll give you a 10x, 20x, 50x, 100x multiple on your revenue. So that's what these VCs actually were validating what the entrepreneur was doing. But in the last year, this is fundamentally changed. I think Kash mentioned on the previous panel about getting to free cash flow and cash flow break even. So if you look at the lines there, you just look at this blue line. So in the Q1 of 2019, the blue line, which is the rule of 40, which is the capital efficiency, was above the green line. But you can see what's happened in the last few years. The green line has completely dominated until the last quarter, 2 quarters, when everyone said you have to worry about capital efficiency opposed to revenue growth. More focus on your unit economics and profitability, EBITDA, free cash flow, than just top-line growth. So that clearly shows you how the market has switched in the last few quarters to focus on the rule of 40. Now, the rule of 40 says you take your revenue growth and your EBITDA margin or your free cash flow margin, and you should at least be at 40%. So if you're growing at 80%, you can still have a minus 40% free cash flow. That's the rule of 40. But the rule of 40 is not good enough to be in the top first quartile of companies. You actually have to get to the rule of 80. So maybe a 60% compounded growth once you're already a large estate company, and 20% free cash flow or 20% EBITDA margin. So that's the rule of 40, which is actually now, with the headwinds that we're facing in the market, has actually come up with the rule of 80 if you want to be in the first quartile. So you have to hit 80% between your revenue growth and your free cash flow. So if you don't understand, you can pop in and ask me afterwards, just so you understand what that rule of 40 or rule of 80 actually means. There's something, who's heard of a burn multiple? Very, very, again, one or two of you, probably the most important number of all. So it's a measure, again, of capital efficiency. So the burn multiple says, if I put $1 million into the business, if I as a VC, as Keynote Venture Partners, puts $1 million into your business, what do I want to see coming out? So from a burn multiple point of view, I want to see $2 million coming out. Okay, so less than 1. So that means the burn multiple there would be 0.5. What's the problem that you see is most of the burn multiples, I'm putting in $1 million and I'm getting $100,000 out. That is that's a burn multiple of 10. You've got serious problems, guys, when you're running at a burn multiple of 10. When you're just starting your companies, maybe it goes to 3, 4, 5. Okay, you're very early stage. But once you start maturing, go to pre-series A, series A, you need to get that burn multiple below 1. The top quartile companies, I'm putting $1 million in, I'm getting $1.5 million out. It's a money-making machine. If you can show me how you can turn my $1 million into $1.5 million, believe me, I'm writing you out a check. So if you just look at the bottom there, so less than 1 is awesome. 1 to 1.5 is still great, and particularly for scale companies, we're looking at about 2. So if you really are scaling fast, you're looking at your burn multiple of being about 2. If you're above 3, you're in very, very bad territory from a unit economics point of view and a capital efficiency point of view. So this is very, very important. So for every dollar that goes into your business, how many dollars are you generating? You have to know that, because if you can give me comfort that it's going to be more than I'm putting in, as I say, I'm writing out a check for you. So that's the burn multiple, which is a combination of free cash flow and your revenue growth. The next efficiency ratio is your sales efficiency. It's also called the magic number. Very, very important one you need to know. So again, sales efficiency doesn't measure your total burn. So the previous one on burn multiple would be your total burn, your COGS, your operating expenditure, your total burn over new revenue. It's not total revenue, it's just over your new revenue. New ARR, new revenue growth, that's what you measure. So if you're doing 100 million today and 150 million next year, I'm only going to count the 50 million. I'm not counting 150 million because you've already generated that 100 million. So as you can see here on the graph here, if your sales efficiency is too low, you reduce your sales. And remember, sales efficiency is your sales and marketing spend. So it's what your sales and marketing spend versus your new revenue. Just sales and marketing. Burn multiple is your total expenditure. Sales and marketing is your magic number. You need to reduce sales and marketing spend, and then if your efficiency improves, you can increase it. But you can see here, you've got a great burn multiple there, but it just gets worse and worse and worse. So where you really want to be is this top right-hand corner, where you've got a high burn multiple and a low sales efficiency, a low burn multiple and a high magic number, sales efficiency number. These are the numbers, guys, that I'm going to look at. Gross margin was something, in all honesty, even myself, I've been in this business for 38 years, in the business of investing, and it's something I never really cared about before. Because if you're in a SaaS business and you're generating 90% or 20% or 40%, for the last few years, no one's actually cared. All of a sudden, gross margin has become a very, very, very critical number. I do not invest in businesses with 10 to 20% gross margin. To me, the top quartile is 80, 90% gross margin. And why? Because of this exact diagram. It just shows if your sales is costing you 45% of your gross margin, what's left is marketing. That's what margin you want. So if it's costing you more than you're getting back in revenue, you're actually beyond this line. So you need to get your gross margins up. There's too many businesses I see today have got 10, 20% gross margins. It's far too low, guys. It's a volume game. You're really going to struggle to spend enough money on sales and marketing to actually get to your unit economics to a level of profitability. So again, it should be 70% above. Less than 50% is not even valued as a tech company. If you show me a 50% less than a gross margin, I don't see you as a tech company. Because tech margins are in the 70 to 90% of those things. And when you've got a lower GM, you're going to get a lower valuation. You might think, no, but someone else got 10x multiple, same company. But they might have 70, 80% gross margins. You've got 20%. You're not gonna get the same valuation as the guys with 78%. So you need to understand all those metrics, including gross margins, are absolutely critical for me as a venture capitalist to come in and invest in your business. So what are the strategies to navigate against the current environment? Number one is the reduction in workforce. Now, unfortunately, what happens with these things is there's two things that Y Combinator came out and Paul Graham came out. Talked about default investable and default alive. Now, what he meant by default alive is you have to have enough cash on your balance sheet that you can actually get to a point of having free cash flow. If you come to me and you've got free cash flow, you've got positive free cash flow, you're generating 10 million revenue, but you're generating 20% free cash flow, believe me, I'm writing you out a check. Because then you actually become default alive. You're alive. And how do you get that? Often most entrepreneurs, if you just look at your current costs, you need to cut your current costs. And how do you do that? You do that through what's being said here. Reduction in workforce. No one wants to reduce their workforce, but if you're not going to get to default alive and you're not going to get that next check from your investor, you are falling over a cliff and you're dying. End of story. You die, your business is dying. Hiring slowdown freeze. I see still businesses looking at growing 100% on their businesses are cutting people left, right, and center. You read it every single day in the press. Businesses in Africa, businesses all over the world. So you have to look at hiring slowdown freeze, even hiring reductions. We've made many hiring reductions in our businesses. Not that they're bad businesses. We just want to get to cash flow break even, and then we actually control our own destiny. When the best time to ask for cash is when you actually don't need the cash. It's the best time to get it. Then you look at spend reductions. You look right through your OPEX and actually make spend reductions. Forecasting must be accurate. Changes to your go-to-market strategy, and then leverage offshore options. You might get cheaper resources on offshore options. But this basically helps you reduce your burn and extend your runway. That's a key thing here, is to extend your runway. Because if you have who's got a current investor here that someone's invested in your business? They've probably told you, don't worry, we'll put more money in your business. BS. Absolute BS. Let me tell you something. When the rubber hits the road and you come back to them and you haven't got the right unit economics or those 6 things I spoke about now, you'll ask them for more money and they will say no. Because they don't see a path to profitability. They don't see you actually making money and they're going to say no. So this thing about VCs will tell you, don't come to me, there'll be more money, is a misnomer. Because until your initial numbers are in the top 25% or 5% in the quartile, you're not getting their check. They're rather going to find a check where they will get their top 5, 10% of businesses. So very important, growth versus efficiency here. So if you look at this, attaining top line growth, so you can just see there, a lot of companies now, so they're missing their top line because that's where you want to be, best top line and with less burn than anticipated. You want to hit your plan, you want to grow at 100% and you're actually spending less than you can. But it's not too bad if you're over here. If you miss the top line, but you spent less burn. You don't want to be there, miss top line and you miss the burn. You want to get up here to the top left or the top right there where you hit your top line plan, but you actually spend less money. But you have to be on top of how much you're spending, guys. That's the point about unit economics. You've got to make sure your unit economics, you understand them, your VC understands them, your capital provider understands them, and they will look at putting more money into your business. So a large majority of companies in 2022 actually missed this top line. They missed this top line plan. But if they cut their burn and miss their top line plan, it's okay. Because that's still a metric that will actually get you to the next check. So let me go to the key takeaways. I think about 15 minutes. I've got about 5 minutes to go. So growth is still the number one metric, irrespective of what I've said there. But it's not the only metric. You've got those 6 metrics that I showed you that you have to focus on. Growth is only one of them, but it is important. If you come to with no growth, but you've achieved profitability, okay, I might look at you. But you want to still, growth is still important. You still want to grow. And that's very important to for any investor that's going to look at your business. So focus on efficient growth. Growth at all costs is over. Those days, unfortunately, are over. It could be a year, 2 years, 3 years, until we go back to these unbelievable days of no one actually caring about your top-line growth, and they're just caring about, now we're caring about efficient growth and to get to cash flow positive and to create a sustainable business. Cash is king. I say to my entrepreneurs, only one job of a CEO. Don't run out of money. Don't run out of cash. Because if you run out of cash, unfortunately, you're dead. You're dead. If you can't make payroll, you're dead. You can go to your investor and he says, look, you didn't hit the numbers. I'm not putting more capital in. Understand, if you can't raise the capital from outside investors, you're not at cash flow break even, your business is over. It's simple. And there's businesses dying every single day, left, right, and center. Then focus on doing few things extremely well. The rule of one. Less is more. You know, I see too many entrepreneurs, they've got £1 million business and they're already in 6 markets with 6 products, etc., etc. That's lack of focus. You cannot do that. No one can do that. Those days of having that amount of capital where you could build 6 products and go into 6 markets are over. Rather focus, and it's contrary to someone's advice in the previous panel, focus on South Africa. If you're a South African business, focus on South Africa. Build your business where you birth it. Build it in South Africa to get product market fit, and then take it and expand it to new geographies, expand it to new products. So what's happening today in these businesses, where they wanted to take it to 6 countries, they're taking it to 1. They wanted to release 6 more products, they may be releasing 1. Less is more. You've got to focus. 1 product, 1 market, 1 customer. Get that focus up. It's nothing. It is a vanity metric to say, I'm in 6 geographies. Okay, what's your revenue? I'm doing 50,000 Rand a month. So what? You've just lost focus completely trying to manage. The level of complexity goes up exponentially every time you try and release new products, new markets, new geographies, etc., etc. So focus is doing a few things extremely well. So don't be a Swiss Army knife. Don't try to be everything to everyone. Slow down your growth initiatives. When I talk about vertical growth initiative, that's more products. You're going vertically, building more products. Horizontal, you're going to new geographies. Slow it down. Slow it down until you can get to free cash. Once you get to free cash, go mad. Go into new geographies, new products, new everything. But don't do it on your VC's money, because if you don't do it and it doesn't work and you spend too much, they're not going to write you out another check. I've already just said now, slow down your freeze on hiring, or slow down your hiring. And your unit economics are absolutely sacred. So know your unit economics, they are sacred. Okay, my last slide. Have a clear horizontal and vertical strategy. So horizontal, remember, is going geographic. So you're going to new markets in Africa, or you're going overseas. Many of the Keynote businesses are already all over the world, but they got to very, very good unit economics before they did that. And now they're going through, as Zach was saying, through distribution partners. So we've got one of our businesses, a cybersecurity business. We're growing 300% year on year. They're looking at another double, going from 30 million to 60 million this year. But they're now going to, we've got about 5 countries we're in. We're going to about 10 countries. But we've got the free cash. We've got the cash to actually go into these multiple markets. So they're going to release new products vertically and go into new geographies on a horizontal level. If you think about the bar, what's happened to the bar in enterprises? There was a bar that was that thick, so the need-to-haves and the nice-to-haves all became need-to-haves. What's happened since the economic downturn is those nice-to-haves have gone. So the bar has gone up significantly. So unless you've got a real need-to-have, you need to have a product that shows a very tangible ROI, return on investment. If you cannot show an enterprise client that you've got an ROI, you're not going to raise their capital. You're not going to get customers. You need to show an ROI. You need to understand value selling. What is value selling? How am I selling? I'm not just selling consultative selling anymore. I have to sell a value sale. So you can show them, you're putting in, you spend with me, Mr. Client, R1 million, but I'm going to give you in 3 months 4 million Rand back in terms of your ROI. They're going to be buying your products. So you have to be able to show a high ROI. Your runway. So I ask lots of entrepreneurs, they come to money, how much runway you got? 2 months. I'm not investing. So we put in $1 million, you maybe get 8 months. I want to see 24 to 36 months worth of runway. The top quartile companies, or top 5-10%, are sitting at 24, 36 months worth of runway. Why? Because that's where for one, they can get to cash flow break even, but also they can ride this wave of economic uncertainty. They can get to a point where they can hopefully raise further capital because we over the worst. So extend your runway. 2, 3, 4, 5, 6 months is not enough. It's going to take you 9 months to raise capital. So if you haven't got at least a year of runway, you're going to be out of business. Trust me, you're going to be out of business. As I said earlier, revenue growth got rewarded in the past. So the burn multiples where you want to get to less than 1, so I want to put in $1 million and get 2 million out, so it goes to a half. They were being rewarded for having burn multiples of 3, 4, 5, 6, 7. They were getting rewarded in the past. But that reward is over. No one is driving top-line revenue at the expense of bottom-line efficiency. You've got to get to efficient growth and not growth at all costs. And you've heard me say that on a few occasions. Every dollar spent must have a good ROI, as I said already. So the VC wants to put in $1 and get $2 to $3 out. And they want that VC money to go a lot further than where it went before. Based on some empirical data they've done in the US, they say it's about 3 to 5 times harder now to raise a Series A than it was a year and a half ago. So just think about that. If you're ready for a Series A and you think you're going to raise it, just remember it's 3 to 5 times harder. Unless you can get to free cash flow, well, then it's going to be significantly easier then they're 3 to 5 times harder. And as I said earlier, customer success should be treated as a revenue generator. Too many people, it should be treated as account management. Too many people think customer success is looking after the client to make sure they're okay. No, it's a revenue generator. Go and make sure you get the net dollar retention from 100 to 120, 140, 150. Some of these companies that are in Africa and I've seen around the world are hitting 150% net dollar retention. So you just think about that. In 2 years, just from their current clients, 2 years at 150%, you're doubling the size of your business. So if you're a $100 million business, not from new logos, not from new revenue, just from your current revenue, and you're doing 150%, in 2 years, you've just taken $100 million to $200 million. The easiest money you possibly can do, but this is overlooked. Everyone forgets about their current customers, and they try and drive new logos and new logos and new logos. As I said earlier, nothing wrong with new logos, but not at the expense of actually just mining your current clients. I remember when I was the CEO of Accenture, I ran a number of different parts of Accenture's business. We were doubling our business literally every 3 years, 26% CAGR. We were doubling our business. We took it to a 4 billion rand business, 2,500 people. That's when I retired at the end of 2010. So that was actually. So in conclusion, are you ready to ride the headwinds of to scale your business into Africa and globally? Everyone, show me. Are you ready? Did you get anything out of this presentation? Are there any? I don't know if there's questions or there's time for questions. I'm not sure. Sorry, just the guy at the back there's got the mic. Yeah, let's go for the first question.
Hi, I'm Basia Nasiorowska. I call myself semi-retired businesswoman, and I wanted to give an advice backing up what you said. This presentation is not happening actually anywhere I haven't seen. You start from this presentation and you stick to those rules. And even if you don't have anybody investing in you, this goes for normal growth of a business. If you don't start from there, you're getting nowhere. And as you said, focus, and then the millions will come.
You're 100% right. This, if you're bootstrapping, that's a great point. This is not about raising capital. If you're bootstrapping or you're raising capital, if you follow these bits of advice, with reductions of OPEX, the 6 metrics, you can build a very, very successful local and global business. But a very good point. Thank you. Is there another question, or have we got time for questions? I'm not sure.
Yeah, we do have time. Audience are quite familiar with the rules of moving down. So we started here, but can we hands in the back?
I think there was a gentleman there that wanted to ask a question. Yeah,
hands in the back. Hands in the middle. Hands in the middle. Going once, going twice. Hands at the bottom. We'll take this one.
Sorry, if you got a question at the back there. I see you got a mic in your hand.
No, he's one of the mic runners.
He's a mic guy. Okay. You don't have a question. I'm going to put you on the spot.
This will be our last question, then we wrap it up. Thank you so much.
Thank you for the presentation. So my question is on the hiring freeze, right? So I would imagine that for a company to hire in the first place, there was a need for that. So is it something you have to anticipate that at some point I want to have to lay off, or is it something that sometimes hits you without even anticipating it?
Oh, sorry, just repeat the question. Sorry,
so my question is, you hired the people for a reason in the first place. And then if I come to you, you're advising me to freeze or let people go. So is that something that I have to anticipate, or maybe structure the contracts in a way that maybe it's not a long-term situation? Or how do you end up in that situation if you needed them in the first place?
I think if you take my advice from today, get to cash flow break even. You got to work it out for yourself. You got to say, I've got enough people. I was planning on hiring, but I want to get to free cash flow, because if I get to free cash flow, my valuation's going to go up. I'm not going to use value in my valuation. I'm not going to have a down round. And I'm going to be able to raise a significant more venture capital at a significantly higher valuation. So I don't want to tell you how to run your business. I'm not you're the operator. I'm not the operator. I'm going to share advice of what I'm seeing from all the downturns that I've seen. But you don't want your venture capitalists to tell you this. You want to go to your venture capitalists and tell them that's what you're doing to actually create longevity and sustainability of your business. So whether you, and the point was raised here, whether you're raising capital or not, do the stuff. And if it means a hiring freeze or it means a headcount reduction, we've got 12, 11 businesses now. I think 6 or 7 of those we've done a headcount reduction. It's hard. It's so hard for the CEO. And I'll tell you, I go out to these CEOs and I'm so encouraged about their leadership ability that they've realized they needed to cut. They discuss it with me. I'm a chairman of most of the companies, and we decide, let's go for that cut. But we're cutting out people that actually, when I ask them, well, what are we losing by cutting out? They say, well, actually nothing. It's okay. Easy decision. We can actually cut them out.
Okay, so my question is, I don't want to get to that point where I'm firing people. So can I prepare for that point and actually hire strategically? Because obviously no one wants to get to that point.
You know, can I be honest with you? Of course we don't want to get to that point. But this global headwinds that are facing us right now, we don't know what's out there tomorrow. So you can do the best of your intentions right now to hire. Nothing wrong with that. But if you see your cash is running out, so you're projecting a certain amount of revenue that you can sustain that number of people you've hired. But let's just say your revenue flatlines or it goes down, and suddenly you realize, if I don't do something cutting my costs, I'm going to run out of cash and my business is over. You got the answer. You got to do it. But remember, when you do that's why I said forecasting is so important. You're forecasting a certain revenue growth, and if you hit that revenue growth, you're not going to have to cut people. But if you just miss it once, then you have to try and get back to, you miss it once, you miss it twice, you miss it 3 times. All your plans have gone out the window. They all say, well, you know, a plan is great until you get punched by Muhammad Ali. Your plan goes out the window. That's the problem. You have got to be, as the entrepreneur, absolutely proactive and understand how hard it is, and you don't want to do it, but you have to do it. Looking at those numbers every single month saying, if you're overshooting the mark on revenue, you can go and hire more people. Absolutely. But the problem is, all the forecasts that I've seen in my entire life, never has anyone actually delivered on their forecast. Never. Okay? So as much as you hire, try and hire under to make sure you're planning on not a stretch revenue target, but maybe just a little bit under par on the revenue target. At least then you don't have to do what you just said now. But just be proactive in your forecasting.
Yeah. We'll do one last question, Christoph, finally.
The boss, I've got to answer the boss. Jeez.
Well, very humbly, Clive, we have one of our fintech portfolio company which has religiously been following your presentation, Africa Arena, followed all these principles, survived COVID without raising capital thanks to reserves, is now over 1 million, well beyond $1 million recurring, growing over 6% a month, EBITDA positive 10%. The question is, what should they do? Should they keep growing within these parameters, maybe lost opportunity, accelerate on growth, but then maybe taking a bit more risk, and if there's a downturn coming, might be losing that, exit? What would you do as an advisor?
I think all of them, Christoph, I'll be honest with you. I think for one, most importantly is, how do they sustain themselves? They've got to be a sustainable business. So what you don't want to do is now go and raise big VC money, pump and go for driving top line growth, which is not what we're measuring as VCs anymore. We're worrying about bottom line efficiency. But the fact you've already got free cash flow, you should be able to get a check quite easily if you want a check. But I would say just keep it going. You're in unbelievable territory. Keep it going. When the market starts turning and the enterprise starts spending again, I would say go and raise further capital or fund it out of free cash, which is the best. So I would just say build up more and more reserves in your cash, and go and drive out new products, new markets from your free cash. I promise you, I'll come knocking on your door. And not just me, all the VCs will knock on your door. Because there are so few companies out there, guys, that have actually got a positive free cash flow. It's so hard to get to, in a tech business, to get to free cash flow. But that's the focus. You have to get to free cash, and the cash will come knocking on your door. I don't know if that answers your question, Christoph, but I would not rush to go and raise VC. I'm a VC, so I'm counterintuitive to myself. But raising venture capital is not always the right answer. Not always the right answer. If you can sustain your business like Google did, where they funded their growth into Waze, into Google Glass, just from their ad business, they funded it out of free cash. Look at the size of that Google business. They haven't raised outside capital to do that. Maybe initially they raised a bit of outside capital. They funded out of free cash. The best businesses today, and I know I've got a few in our portfolio, we're funding all our growth out of cash. We don't want to raise more capital because, for one, the valuations are low right now. There's not enough liquidity in the marketplace. We just keep on growing nicely, 6 to 10% month on month. And when the economy turns around and there's a lot more capital in the capital markets, we'll go and raise a big round. But that's okay at that time, because maybe we can get back to driving top-line growth opposed to just driving capital efficiency and bottom line and top-line growth. Guys, I hope that's been useful. I should be out there. I hope you can learn some of these lessons, because I learned the hard way. But thank you very much.
Thank you very much, Clive. Once again, big round of applause. That wasn't loud enough. That was a fantastic presentation.